What if the single barrier between your current finances and real wealth isn't information, but a set of predictable mental habits you can change this week? This audiobook distills the operational core of mastering the money mindset into sharp, testable moves, how to frame choices so risk becomes manageable, how to convert vague goals into measurable financial experiments, and how to replace reactive money behaviors with repeatable decision rules that compound over time. You will get concrete rituals to automate margin, a simple checklist to evaluate every spending and investment choice, and one tactical weekly experiment you can run to produce real evidence of progress. Listen for one rule you can apply within 7 days, commit to testing it, and treat the result as data rather than judgment. Change your thinking, and the financial moves that follow will stop being accidents and start being deliberate. Chapter 1. Reframe money as power to choose. The first practical move toward mastering the money mindset is a cognitive reframe. View money not as a scorecard of worth or a source of anxiety, but as a tool that buys options, preserves time, and reduces needless friction in daily life. This is not an intellectual exercise. It changes decisions immediately. Begin by inventing a single operational definition of money for your life. Money equals optionality. Put that sentence somewhere you will see it daily and measure decisions against it. When faced with a purchase, ask how that spending increases or decreases optionality over the next 12 months. If the answer is negative or ambiguous, pause. To make the reframe actionable, run a 1-month experiment where every discretionary purchase must be documented with a 1-line justification tied to optionality. At the end of the month, categorize purchases into 3 buckets: increases optionality, neutral, and reduces optionality. Likely you will discover patterns: subscriptions that add friction rather than freedom, identity purchases that deliver transient joy, and small margin-building moves that compound. Use this empirical audit to reallocate even modest sums toward actions that demonstrably expand choices: building a small emergency fund, investing in a course that opens potential freelance clients, or paying for a service that saves significant time each week. The second element of the reframe is identity re-engineering. Many people's money behavior is driven by a story, scarcity, deservedness, or conspicuous signaling that operates below conscious intent. Identify your dominant money story by writing for 10 minutes about your earliest money memory and the lesson you extracted. That memory shapes how you respond to windfalls, losses, and opportunities. Once externalized, the story is easier to test. Create a micro-counter-narrative and test it in low-risk contexts. If your story says you must hoard to be safe, try a small, timed generosity experiment and observe emotional shifts. Over weeks, the new micro-narratives weaken the automatic old reactions. Third, operationalize frames into rules that reduce reliance on fluctuating willpower. Example rules: always preserve 3 months of living expenses before increasing discretionary spending. Automate a fixed % of income to investments and to an option fund. Require a 48-hour pause for identity purchases larger than a modest threshold. Rules convert the optionality frame into behavior and freeze progress against emotional noise. Fourth, convert money decisions into experiments rather than moral tests. When tempted by a larger upgrade, design a short pilot, borrow a model, rent it, or simulate the lifestyle change for 2 weeks before committing. Measure the net effect on mood, time, and optionality. The experiment model preserves reserves, financial and psychological, while generating evidence to inform future scaling. Finally, create a daily micro-ritual that aligns attention with the reframe. Spend 2 minutes each morning scanning one metric, a running balance of your margin fund, a one-line note about an optionality decision you made yesterday, or a reminder of your one-sentence money definition. Small, consistent attention aligns actions with the new cognitive frame and slowly hollows out the old reactive habits. Reframing money as the power to choose is simple, but its practical consequences are profound. It creates a decision filter that improves every subsequent financial move and converts abstract goals into testable, repeatable behavior. Chapter 2: Emotional Forces and Decision Architecture. Mastery of money is primarily a mastery of the emotions that distort decision-making, fear that freezes you into safety, scarcity-driven hoarding, impulsive joy-seeking, and envy-fueled escalation. The first practical step is to externalize these emotions into predictable patterns and then design decision architecture that neutralizes them. Start by mapping 3 emotional triggers that most often lead you to poor financial choices: stress spending, peer-driven upgrades, or paralysis by analysis. For each trigger, design a one-step cold protocol. For stress spending, the protocol might be a 30-minute pause paired with an immediate 2-minute breathing reset and a short logging question. What problem am I trying to solve with this purchase? For peer-driven upgrades, require a substitution test. Before upgrading, commit to reallocate the same money toward a proven emotional return anchor for 90 days. If your life improves more from the anchor, cancel the upgrade. For paralysis by analysis, limit options. Reduce choices to 3 vetted alternatives and schedule a short decision window of 48 hours. Next, institutionalize temperature checks, simple physiological or behavioral signals that indicate when emotion is high and judgment is unreliable. A basic check could be heart rate or a subjective stress score out of 10. If the signal is above a threshold, shift to the cold protocol. This converts internal turbulence into external steps that preserve rational action. Another powerful element is pre-commitment. Use financial pre-commitments to lock in desirable future behavior and to remove temptation. Examples include automated transfers to savings and investment accounts upon payday, prepaid subscriptions for learning that force completion pressure, or binding public micro-commitments where you post a one-line promise and a small penalty for missing it. Pre-commitment reduces the cognitive tax of future decisions and uses structural friction to keep you on course. Behavioral nudges also help redesign the environment so defaults favor good outcomes. Hide credit cards, require 2-factor confirmation for big purchases, or maintain a visible margin balance that discourages impulsive depletion. Finally, schedule regular emotional audits where you review decisions made under emotional pressure and analyze the input-output mapping. What triggered the choice, what rule failed, and what micro-rule would have prevented it. This reflective loop converts emotional lessons into improved decision architecture. Money mastery is less about removing emotions and more about designing predictable, low-friction responses that preserve rationality when emotions inevitably spike. Chapter 3: Margin systems, automation, buffers, and the Joy Fund margin is the operational spine of a robust money mindset. It is a deliberate, automated buffer that buys time, reduces stress, and creates the freedom to act on high upside opportunities. The first practical program is automation. Define 3 automated transfers you will implement immediately. A margin buffer transfer to a liquid account, an investment transfer to a diversified vehicle, and a joy fund transfer to preserve small, repeated pleasures. Set these as automatic rules on payday so allocation happens before discretionary temptation arises. Even small percentages, 3 to 5% for a joy fund, 10% to a margin account, and a disciplined investment amount, compound behaviorally and financially. Second, calibrate buffer sizes to your personal risk and runway. For freelancers or people with volatile income, target a larger margin, 6 to 9 months of essential expenses. For stable salaried workers, a 3 to 6 month buffer is a practical minimum. Convert buffer targets into clear stop rules. Do not commit to long-term contracts or large purchases if your margin is below the threshold. Third, operationalize the joy fund to prevent austerity fatigue. Choose a modest monthly allotment and define the categories that qualify: small rituals, micro trips, or regular classes, and protect them as sacrosanct. The joy fund concept preserves morale and reduces future impulsive spending because small delights are already budgeted. Fourth, create a rapid redeployment playbook for margin activation. If an opportunity appears, an asymmetric investment, a short-term buyout, or a strategic hire, have a pre-written protocol that specifies the decision maker, the allocation cap, and the short pilot conditions. Margin with a playbook becomes optionality you can act upon rather than hoarded inertia. Fifth, integrate technological aids to maintain margins without cognitive overhead. Use separate accounts with clear labels and services that round up transactions into savings, or allocate a portion of windfalls automatically. Use alerts for margin thresholds and simple dashboards that surface runway days remaining. Finally, institutionalize monthly margin reviews. Spend 10 minutes verifying balances, rebalancing allocations, and considering whether to accelerate any pilots. These short, scheduled checks maintain discipline and turn margin from a vague concept into a living financial asset that reduces reactive decisions and increases opportunity capture. Chapter 4. Investing. Mindset, time horizons, optionality, and small asymmetries. Investing wisely is less about clever timing and more about aligning instruments to time horizons, preserving optionality, and hunting for small asymmetries you can scale. Begin with clear horizon buckets, near-term for liquidity needs, medium-term for growth with accessible capital, and long-term for asymmetric compounding. Explicitly allocate capital across these buckets with rules for movement. Only move funds from long-term to short-term under pre-specified stress conditions to avoid panic selling. For each bucket, set selection criteria tailored to the horizon. Short-term prioritizes liquidity and capital preservation. Medium-term favors diversified growth assets and minimal leverage. Long-term can include illiquidity for higher potential returns and concentrated optionality plays. Optionality is the most powerful investing habit. Keep a small dedicated allocation for high upside, low probability bets where loss is limited but gain is large. Treat these as research capital, small bets, with staged increases only on positive signals. Use staged allocation rules, initial micro allocation, signal threshold for scaling, and a hard cap to protect core capital. Another crucial mindset is asymmetry hunting. Rather than aiming for a single big winner, design portfolios of many small asymmetrical ideas where expected value is positive and downside is bounded. Examples include buying small stakes in underrated businesses, investing time for low-cost options like depth research or skill acquisition that creates asymmetric career moves, or securing non-dilutive agreements that pay back on success. Diversification matters, but the disciplined addition of asymmetry opportunities multiplies expected return without exposing the entire portfolio to catastrophic loss. Tax, fees, and behavioral costs are invisible return drains. Minimize turnover, prefer low-fee vehicles for core exposure, and automate rebalancing to prevent emotion-driven trades. Finally, adopt a decision ledger for investments. Record the thesis, the worst plausible outcome, and the signal that will change your mind. Review the ledger quarterly to refine selection filters and to detect biases. Investing with horizons, optionality rules, and asymmetry experiments aligns capital with the most powerful financial law, time, and turns disciplined small bets into transformative long-term results. Chapter 5: Income Design and Behavioral Execution. Creating and scaling income is the most actionable lever for improving financial outcomes. The practical architecture separates income into active, productized, and leveraged strands. Active income pays today, consulting, employment, or contract work that stabilizes cash flow. Productized income packages expertise into repeatable offers, short courses, templates, or managed services that reduce marginal effort. Leveraged income multiplies reach through licensing, subscriptions, or platform distribution. The tactical sequence begins with securing stable active income sufficient to fund margin and small experiments. From that base, commit fixed, scheduled time, for example 6 hours per week, toward productization. Use a tight build, measure, learn loop. Identify a narrowly defined buyer problem, create a minimal deliverable, sell to a small cohort, measure retention and outcome, improve, then scale distribution. Pricing should be outcome anchored rather than time anchored. Charge relative to the value delivered and iterate on entry-level offers to lower friction. Delegation and playbooks preserve time, codify the service into a short operations manual, and validate a contractor with a tiny paid pilot before handing over full volume. For leveraged income design, simple distribution experiments, affiliate pilots, platform placements, or licensing tests with clear conversion and margin metrics. Scale only once unit economics exceed a small threshold and retention shows repeatable value. Behavioral execution is the glue, habit design and governance. Protect prime work time in your calendar and pair it with a one-line weekly outcome metric. Run weekly reviews that compare effort inputs to revenue outcomes and adjust accordingly. Use commitment devices, public announcements, small monetary penalties for missed targets, or partner accountability to keep productization momentum. Finally, practice micro-experiments to expand income streams, 3-month sprints, followed by short post-mortems to capture one repeatable improvement and one new opportunity. Income design married to disciplined execution converts time into systems, systems into scale, and repeated small experiments into sustainable financial freedom. Chapter 6: Scaling through systems and delegation. Scaling wealth and influence requires turning individual effort into durable systems and then delegating those systems to capable teams. The practical sequence begins by isolating the repeatable elements of your work and converting them into clear processes that others can execute with predictable quality. Start with an inventory. List every recurring task that contributes materially to revenue or strategic progress, and rank each task by strategic importance and repetitiveness. Tasks that are high volume but low strategic importance are the best early delegation candidates because they free your time quickly while reducing operational risk. For each candidate, write a one-page playbook that covers scope, inputs, step sequence, common errors, acceptance criteria, and a short quality checklist. Keep language concrete and example-driven so a new person can run the task and check results against the checklist. Validate the playbook with a micro-pilot. Hire for a single paid sprint. Give the contractor the playbook, monitor the output closely, and refine the documentation based on observed gaps. This iterative documentation pilot refine loop converts tacit skill into teachable process and reduces the time cost of onboarding. Parallel to documentation, build a small governance structure that protects decision rights. Preserve strategic decisions for you and delegate operational choices to others with clear thresholds. Define what level of deviation from plan requires escalation and what can be handled autonomously. This reduces micromanagement and protects your attention for high-impact work. Financially model delegation decisions with marginal return thinking. Calculate the cost of delegation versus the value of the time liberated, keeping in mind that early hires will often underperform until processes improve. Use short trial windows and outcome-based payments where practical to align incentives. Automate repetitive flows before delegating them. Billing, reporting, onboarding sequences, and routine communications can often be partially automated with simple tools and templates, increasing scalability and reducing error. Invest in a compact stack of reliable tools that limit cognitive switching for team members rather than a sprawling set of apps that require heavy training. As capacity grows, create role-focused ownership rather than task-based assignments. Ask one person to own an end-to-end outcome such as new client onboarding rather than splitting that across many hands. Ownership reduces coordination overhead and improves accountability. Culture matters. Practice rapid feedback cycles, celebrate small wins publicly, and institutionalize short retrospectives after each project to capture improvement actions that feed the playbooks. A small governance cadence, weekly tactical syncs, and a monthly strategic review keeps alignment without daily interruptions. Finally, protect optionality as you scale. Keep a reserve of time and capital to pilot new ideas and maintain a small percentage of personal involvement in learning signals from the front line. Scaling is not simply hiring more people, it is the disciplined conversion of individual methods into replicable systems, training others to execute with clear rules, and preserving the cognitive space to discover the next asymmetric opportunity. Chapter 7. Advanced Investing, Edge, Concentration, and the Long Game. After mastering basics of allocation, a more advanced investor develops edges through specialization, disciplined concentration, and patient compounding across long horizons. Edge begins with domain depth. Choose a narrow sector, instrument, or geographic market where you can learn faster than market's price. Depth allows you to spot mispricings and structural change before others do. The practical approach is to pair focused research time with small exploratory stakes. Start with tiny positions that give you access to live feedback and sharpen thesis formation. Keep a decision ledger for each idea, note the initial hypothesis, key indicators you will watch, and explicit scaling triggers that move capital from exploratory to meaningful sizes. Concentration enhances returns when your edge is real, but it magnifies error if your knowledge is cosmetic. Manage concentration with caps and kill thresholds. Define a maximum exposure to any single idea relative to your portfolio and a rule that triggers reduction if objective signals deteriorate beyond agreed tolerances. Diversify structurally across non-correlated engines of return rather than across superficially different assets. For example, combine a core low-cost diversified base with a portfolio of concentrated, high-conviction positions sized to your confidence and evidence. Time horizon discipline remains central. Long-dated compounding rewards patience and reduces the frictional cost of frequent changes. Where possible, use tax-efficient wrappers and low-friction vehicles that allow holding through volatility without forced selling. Chapter 8. Behavioral Resilience and Decision Fitness. Your best financial strategies will fail if psychological fragility causes overreaction at the wrong moment. Behavioral resilience is the set of habits, protocols, and identity practices that keep you executing sensible plans when stress spikes. Begin with predictable, low-friction calming rituals for acute volatility. 3 slow breaths, a time-stamped 30-minute pause, and a short checklist that reviews your original decision memo before taking any action. This ritual interrupts emotional impulses and forces a return to the plan. Pre-commitment devices are the systemic counterpart, rules you set today that limit future harmful reactions. Automated investment schedules, pre-specified stop-loss bands, and allocation thresholds that require a second opinion before change. Use external scaffolding to enforce these commitments, a trusted advisor, a small investment committee, or a public accountability mechanism that raises the social cost of rash moves. Emotional fitness also benefits from identity anchoring. Write a one-paragraph investment identity that states who you are in financial markets and what long-term purpose guides your choices. Review it weekly so shocks are filtered through identity rather than fear. Practice simulated stress tests, run tabletop exercises where market scenarios play out, and you rehearse responses with your team or advisor. Rehearsal reduces surprise and improves response quality. Recovery rituals after losses are crucial. Have a short after-action protocol. Document what happened, what signals you misread, and one behavior change to test next. This converts pain into learning and prevents shame-driven paralysis. Decision fitness extends beyond acute crises. Manage chronic fatigue and decision depletion by protecting cognitive bandwidth. Schedule high-stakes choices in your peak energy windows, automate routine allocations, and outsource low-value decisions. Social support matters. Create a small circle of experienced peers who can act as sounding boards and who will call out your blind spots. Finally, cultivate humility rituals, small recurring practices that remind you of fallibility, such as reviewing historical errors, reading contrarian perspectives, and retaining a devil's advocate in major decisions. Behavioral resilience is not about emotion suppression. It is about engineering predictable responses and muscular recovery, so your long-term compounding is uninterrupted by avoidable behavioral drift. Chapter 9. Social capital, networks, and the currency of trust. Financial outcomes are tightly coupled to the social networks you cultivate. social capital, trust, reciprocity, and relevant relationships, creates access to deals, accelerating learning, and distribution channels that no amount of solo effort can replicate. Treat network building as strategic investing with its own allocation logic. Identify 3 categories you need access to: peers who operate at your target level, domain experts who sharpen your edge, and distribution partners who amplify your offers. Invest small recurring resources in each category: time for weekly check-ins, contributions of valuable content, and intentional reciprocity such as introductions or micro-collaborations. Reciprocity is the amplifier. Give before you ask and create small, scalable value exchanges that anchor relationships. For example, short research notes, curated introductions, or a compact shared project that yields early mutual benefit. Create governance of outreach. Maintain a contact ledger with context about past interactions, mutual interests, and potential collaboration ideas, so follow-ups are relevant and not transactional. Use public artifacts to build trust and credibility: a short case study, a concise playbook, and public acknowledgements of collaborators that celebrate shared wins. When evaluating partnership opportunities, prefer those structured as pilots with clear success metrics and a scalable path to broader collaboration. Pilots reduce friction and reveal operational fit quickly. Manage reputation proactively. Be explicit about what you will do reliably and what you will not. Reliability is the most valuable currency in networks, and it compounds through referrals and trusted introductions. Finally, integrate your social capital strategy into execution. Align network activities with business objectives by scheduling intentional outreach during launch windows, using mentors to validate hypotheses, and leveraging partners for distribution. Social capital is not decorative. It is an asset class that produces deal flow, accelerates learning, and magnifies the impact of your other investments. Chapter 10: Stewardship, Exit Planning, and Designing a Life for Freedom. Mastery of money culminates in stewardship, designing how wealth will be used to create purpose, preserve freedom, and support others across time. Start by articulating a concrete, enough target tied to lifestyle goals and a purpose statement describing what wealth enables for you and those you care about. This clarity guides spend versus invest decisions and reduces the drift toward lifestyle inflation. Build an exit and succession framework early. Document critical processes, train successors through staged responsibility increases, and maintain clean, auditable financial records that make transitions orderly rather than disruptive. For business owners, engineer exit optionality with multiple paths: partial sales, licensing, management buyouts, and earnouts, rather than a single liquidation event. For investors, plan liquidity windows that align with life goals rather than market cycles. Avoid forced sales by preserving a runway of liquid reserves. Philanthropy and giving are powerful levers of purpose and legacy. Design a giving plan that is intentional, measurable, and integrated with tax and governance considerations. Automated, recurring giving protects generosity from being crowded out by convenience spending. Estate basics matter. Create directives, wills, and simple trust structures that reduce post-event friction and preserve continuity for heirs. Stewardship also requires periodic introspection. Schedule annual reviews to test whether your financial architecture still serves your life goals, and to update the enough definition as priorities evolve. Finally, cultivate the art of presence. Wealth is most valuable when it buys time for attention, relationships, and meaningful projects. Treat money as infrastructure for a chosen life and design systems that keep options open, obligations light, and opportunities frequent. In that architecture, financial mastery becomes the means to a life of agency, contribution, and durable freedom. Conclusion: small rules, long horizons, and the practice of wealth. Mastering the money mindset is less about clever hacks and more about building a discipline of rules, experiments, and resilient systems that persist through stress. Start with 3 small actions this week. Write or revise your one-page decision playbook, automate a modest transfer to a margin account and to a joy fund, and run a 12-day pilot on a small optionality idea. Document the outcomes, refine your rules, and repeat. Wealth accumulates when sensible small moves are repeated and protected over time. Patience and disciplined iteration are your most reliable allies.